everyone, and welcome back to the Money Clarity channel. I'm so thrilled you're joining me for today's video. Before we dive into things, please take a quick second to hit that subscribe button, share this video with a friend, leave a comment below, drop a like, and turn on the notification bell so you never miss out on finding true financial clarity. Okay, let's jump straight into what literally everyone is thinking about right now. The S&P 500 just crossed 7,600 points. That's a historic all-time high. And yet, instead of celebrating, most people are completely stressed out. Well, here's the truth. When the numbers get this high, it carries hidden investment risks. And that's not necessarily because the market itself is flawed, but actually because of how we as humans instinctively react to it. You might be asking yourself right now, should I pull out? Should I just wait? Is this the absolute top? Is a massive crash coming? If you're asking those questions, I hear you. And honestly, I get it. If you're a new investor focused on building long-term wealth, I am speaking directly to you today. When you see scary headlines, your gut naturally screams that something is horribly wrong, and you need to just do something to fix it. But I want you to think of market volatility like common household weather patterns. I mean, you wouldn't sell your house just because a heavy thunderstorm rolls through, right? It's just weather. So today, we're going to calm that anxiety and look at exactly what you should do with your investments right now so you don't make a really expensive mistake. Here is our roadmap for today's video. We'll be looking at 1. The all-time high paradox. 2. Fact-checking the current market. 3. Two camps of investors. 4. What history actually says. 5. 5 moves for right now. And 6. Defeating the real enemy. Let's get into it.
Starting with Section 1, the all-time high paradox. Why high feels terrifying.
So here's the really weird thing about where we're at right now. The market is at an all-time high, but investor anxiety is also at an all-time high. Most of us feel the safest investing when the market is low and completely terrified when it's high. This paradox costs people an absolute fortune, and this setup right here brilliantly illustrates why our brains are just so conflicted. Look at this split screen. On one side, we have objectively strong economic fundamentals. The S&P 500 is up over 10.7% just since January. Corporate earnings are incredibly strong. AI companies are raking in massive revenue, and the labor market is holding steady. But then on the exact same day, you look at the other side. We've got conflict in the Middle East driving up oil prices, inflation stubbornly sitting way above the Fed's target, and everywhere you look, someone is on the news claiming a crash is absolutely inevitable. Your brain sees the growth, but your gut feels the fear of the news.
Moving on to Section 2. Fact-checking the current market, the real picture as of June 2026.
To get a truly clear view of things, we have to separate our emotional reactions from the actual mechanics of the market. And what's really interesting here is this specific number, 7,609. The S&P 500 just hit this mark. Now, when people see a number this high, they instantly think of past market bubbles, like the infamous dot-com bubble of the early 2000s. People assume this must be a fragile house of cards just waiting to collapse. But guys, that's not a bubble talking. That is the actual tangible valuation of these companies as of this week. In fact, Goldman Sachs had 7,600 set as their year-end target all the way back in April. We didn't falsely inflate to get here, we just simply hit their target a little early. Let's break down exactly what is happening right now with 4 hard facts. First, the market already had a crash this year. The S&P dropped nearly 10% back in Q1. Second, it followed that up with a massive V-shaped recovery, gaining 10.5% in April alone. If you panicked in March and sold, well, you completely missed it. Third, the engine driving this is real capital, not just hype. AI investment is driving about 40% of the S&P 500's earnings growth, with companies like Alphabet announcing massive $80 billion spending plans. And fourth, yes, real risks absolutely remain. Oil prices are elevated and inflation is undeniably sticky. If these factors cause some economic cooling, I want you to use a simple nature metaphor to think about it. It's just like the changing of the seasons. Summer growth doesn't last forever without a cool autumn to reset the environment. It's totally natural. We have strong fundamentals, real risks, and a nervous crowd. That is perfectly normal. Which brings us to Section 3. Two camps of investors. Stay the course versus hedge. Because of this strange mix of strong data and scary headlines, investors have firmly split into 2 very vocal camps, and both are trying to tell you what you quote-unquote must do. Let's look at the 2 sides. Camp A says, stay the course, don't touch a thing, keep investing because markets always go up over the long run and timing the market is impossible. They love to remind us that people who pulled their money out in March 2020 missed the fastest recovery in history. Then you've got Camp B. They say, Hedge and protect yourself right now. At 7,600, valuations are stretched way too thin. You need to move into defensive assets like gold, bonds, or dividend stocks before the music stops. So, what's my honest professional take? Well, both camps are kind of right, and both camps are completely wrong. Because the right answer has absolutely nothing to do with what the market is doing, and literally everything to do with your specific timeline, your personal goals, and what you are actually trying to achieve.
Let's look at Section 4, what history actually says. Data destroys fear. To figure out which camp you actually belong in, we first need to look at what history tells us. This is my favorite part because data destroys fear every single time. Take a look at this number, 3. Since 1950, the S&P 500 has hit a new all-time high roughly once every 3 weeks on average. Just let that sink in for a second. Every 3 weeks. New highs are not rare, terrifying anomalies. They are literally the default state of a growing economy. Think about it. If the economy is expanding, the market should theoretically be hitting new highs all the time. And this builds to a point that usually shocks people. Studies from huge institutions like JP Morgan and Vanguard show that investing at all-time highs actually outperforms investing at random times. Why is that? Well, because all-time highs tend to cluster together during sustained bull markets. Momentum just carries them forward. The data is absolutely crystal clear on this. Sitting on the sidelines waiting for a massive dip is mathematically a losing game. Now, does that mean the market can't drop from 7,600? Absolutely not. Drops are a guarantee in this game. Historically, market corrections of 10 to 20% happen roughly every 1 to 2 years. And a bear market, meaning a drop of 20% or more, happens every 3 to 4 years on average. Going back to our weather metaphor from earlier, a 10% correction is just a rainy afternoon. A 20% bear market, that's a tough winter storm. But they are normal, expected weather patterns for our economy. So the question you really have to ask yourself isn't, will it rain? But rather, if it storms tomorrow, would it actually ruin my life, or would I just stay inside and wait it out? That brings us to Section 5, 5 moves for right now, actionable steps to protect your portfolio. This is the most actionable part of our video today. I'm going to walk you through a clear framework. There are 5 moves here, but I want to provide you with 3 simple steps for adjusting your portfolio specifically during these record highs, plus 2 bonus tips for your mindset. Here are your 3 adjustment steps. Step 1, audit your time horizon first. Before touching anything, ask yourself, when do I actually need this money? If it's more than 5 years away, today's market level is almost entirely irrelevant. If you need it in 12 months, okay, that's a different story. Step 2, rebalance, don't retreat. If the bull market pushed your stocks to, say, 90% of your portfolio, but you only ever intended for 70, sell some stocks, buy some bonds, and get back to 70%. You're locking in gains and restoring your chosen risk profile. That is not panic selling. Step 3, keep investing, but drip feed. If you're anxious about dumping a lump sum in right now, just use dollar cost averaging. Put in a fixed amount every month so you naturally buy more shares when prices dip. It completely takes the emotion out of the equation. So those are your 3 adjusting steps. Now for the remaining 2 moves to protect your strategy. Step 4, don't overhedge. 1 layer protection is plenty. A 5 to 10% allocation in defensive assets like short-term bonds or gold is totally reasonable. But sitting on 40% cash waiting for a crash, that means fear is making your decisions. And finally, step 5, stop watching the daily market. Checking your portfolio every day just gives the market permission to dictate your mood. Honestly, checking once a month is more than enough. Finally, Section 6, defeating the real enemy. Mindset over panic. Following those steps we just talked about is incredibly powerful. But to truly succeed over the long run, we have to talk about defeating the real enemy. Because honestly, the real threat to your long-term wealth isn't inflation. It isn't global conflict. The real enemy is the version of you that panics. Every single major market crash in history has been followed by a recovery. Every single one. The people who got truly permanently hurt weren't the people who just stayed invested and rode out the storm. They were the people who sold at the absolute bottom purely out of fear, and then they never came back. Right now, at 7,600, your gut might be a little nervous. But in the stock market, dealing with a nervous gut while the market hits a new high, that's literally just called a Tuesday. The simple fact that you are sitting here watching this video means you are already ahead of 90% of people who just blindly react to the news. So, I have a quick homework assignment for you. Before you make a single move in your account, I want you to physically write down why you are invested. Write down your specific goal, your timeline, and your ultimate target number. When you are crystal clear on your why, deciding what to do with your money becomes incredibly simple. If this video helped you think just a little more clearly about your money today, please hit that like button right now. It genuinely helps the Money Clarity channel reach and help more people. I've also linked 2 incredible resources down in the description on building a recession-proof portfolio and how to master dollar cost averaging. Definitely check those out, subscribe to the channel, and turn on the notification bell so we can keep building wealth together. But before I go, I want to leave you with one final very important question to ask yourself tonight. If the market unexpectedly drops 20% tomorrow, is your portfolio built to survive it, or is your mindset going to be the thing that breaks first? Think about it. I'll see you in the next video.